All right, let's talk WeRide. Their second quarter earnings just dropped, and honestly, it's a real head scratcher for investors. On one hand, you have absolutely explosive growth. On the other, the stock got completely hammered. So what's going on here? Let's break it down. Okay, so first things first, let's look at the number that had everyone talking. A massive, almost unbelievable 836.7% year-over-year jump in Robotaxi revenue. No, you're not misreading that. This is the kind of hypergrowth that signals a business is hitting a serious inflection point. But, and this is a huge but, look at how the market reacted. In the 2 days right after this incredible number came out, the stock dropped 7.6%. So, amazing growth, sinking stock. That is the core of the puzzle we're going to unpack today. It's really a classic tale of two tapes. You've got the earnings report, which is screaming buy, buy, buy. And then you've got the stock chart, which is telling a totally different, much gloomier story. So what gives? What did Wall Street see that the bulls might have missed? To really get to the bottom of this, let's start with the good stuff. We've got to build the bull case first, because on paper, this was an absolutely stellar quarter. The results were solid, top to bottom. And when you dig into the numbers, it's not just a one-trick pony. Total revenue shot up over 60% to $17.8 million. Product revenue more than tripled. But the main event, of course, was Robotaxi, which went from being a rounding error to a serious, major driver of the business. You can see this strategic shift happening in real time right here in the revenue mix. Robotaxis is now responsible for over a third of the company's total sales. Think about what that means. This isn't just some science project anymore. It is rapidly becoming the core commercial engine. The move from the lab to the street? Yeah, it's happening. And it's not just the financials. Operationally, these guys were just executing, plain and simple. They're rolling out in massive global cities. Dubai, Riyadh, Shanghai. Their fleet with Uber tripled in just 6 months. They locked down critical driverless testing permits. And they did all of this while sitting on a very comfortable 4.1 billion RMB in cash. Okay, so with all that incredible news, why on earth did the market give it the cold shoulder? Let's flip the script now and take a look at the other side of the coin. It's time to read the bearish tape. So here's how it went down. The stock dipped almost 2% on earnings day, but the next day, the selling really picked up, and it fell another 5.8% on heavy volume. And here's the real tell. The options market was already flashing warning signs. We saw a put-to-call ratio of about 2.5. In plain English, that means for every one trader betting the stock would go up, 2.5 were betting it would go down. The pessimism was already there. So this brings us to the core question. How do we decode this disconnect? Well, it really boils down to a classic Wall Street tug-of-war. Incredible operational progress on one side and the relentless demand for profitability on the other. So you've got these two competing stories, right? The bulls are looking at that insane growth, the global rollout, the new tech, and the huge cash pile, and they're thinking, what's not to love? But the bears, they're pointing straight to the bottom line. They see the net losses, they hear management being a little vague on guidance, they see the stock lagging the sector, and they're worried the company will have to sell more shares down the line. Now, management is not deaf to these concerns. On the earnings call, CEO Dr. Tony Han went right at it. He kept highlighting their new tech, the HPC 3.0 platform, calling it a game changer. And the most important part of his message wasn't that it's just faster or better, it was that it cuts costs by a massive 50%. That's their answer to the profitability question. So what exactly is this HPC 3.0? Well, think of it as the brand new, super-powered brain for their cars. It's an absolute beast of a computer, running on dual NVIDIA Thor chips and delivering an insane 2,000 trillion operations per second. But the goal isn't just power. The goal is to make it cheap enough to actually make money. It's all about getting the unit economics right so they can deploy thousands of these things profitably. All right, we've laid out the bull case, we've laid out the bear case. So what's the verdict? Here at Talk Tickers, what's our call on WeRide's path forward? Let's get into it. Here's our forecast. For Q3 revenue, we see that strong year-over-year growth continuing as the expansion in the Middle East and Shanghai really starts to kick in. The stock price, though, we think it's going to be range-bound with a good deal of volatility. You're going to have this constant battle between great operational news and those nagging profitability concerns. For that reason, our rating is market perform. The execution is fantastic, but Wall Street is in show-me mode. It needs to see proof of margin improvement before it's willing to re-rate this stock higher. Now for the traders out there. How could you play this? Here's an idea. A pairs trade. On one side, you go long WeRide. The bet is that the market is just plain wrong right now, and eventually it has to reward this level of commercial execution. To hedge yourself, you simultaneously go short the CARS ETF. That's a basket of autonomous driving stocks. This protects you if the whole sector takes a dive and helps you isolate WeRide's specific story. The goal is to capture alpha from the market re-rating WeRide for its execution, which, frankly, seems to be outpacing its peers. And as always, our final and most important note: this is not financial advice.